Welcome to this Hantec Markets video on breakout trading. Prices for any security can move in three directions: up, down, or sideways. Prices moving sideways or consolidating present traders with two options: range trading or breakout trading. Range trading relies on prices continuing to oscillate within a range. Once the range is identified, the aim is to buy when prices drop to the lower end of the range and sell when prices reach the upper end of the range. This is made easier in the FX market by the fact that you don't have restrictions on taking short positions as you do with some other markets. However, in many instances, by the time a range is identified, prices may well be on the verge of breaking out. The other option, which is the subject of this video, is to engage in breakout trading. One of the benefits of breakout trading is that when prices break from a well-defined range, the move often results in a substantial change in price. If you manage to catch the breakout, the rewards can be significant. Looking at this daily chart of sterling US, you can see that we have identified a clear range of consolidation between a low of 1.7230 and highs at 1.7623. Assuming that we don't know which way prices are going to break from the range, we need to be prepared for a move in either direction. Accordingly, we need to select a buy level just above the range to catch any break to the top side, and a sell level just below the range to catch a possible downward breakout. In this particular instance, let's assume that we've decided to use 1.7660 as our buy level and 1.7195 as our sell level. Instead of using the regular market execution order type, we need to place a pending order on the MT4 platform. The order to buy at 1.7660 will be a buy stop, and the sell at 1.7195 will be a sell stop. In other words, as soon as one of those levels is broken, the relevant order will be triggered. As you can see, the breakout from this range was in fact bullish. This breakout would have triggered the buy stop order at 1.7660, giving you a long position as prices commenced a substantial rally. Even if there had been some slippage on the execution of the buy stop order, you're still likely to achieve a far better result than a trader that waited for the breakout prior to placing a trade. Following this breakout, prices began a rally of more than 1,300 pips without ever slipping back into the range. Initially, the order that was not triggered by the breakout, in this case the sell stop, can act as a stop loss for the newly established position. However, as the new trend progresses further away from the range, it would be a good idea to trail your stop loss behind prices to progressively lock in some of the gains. Of course, periods of consolidation aren't always defined by horizontal lines of support and resistance. Breakouts from other patterns also present a trading opportunity. The triangular pattern on this chart developed over a period of several months, but when prices finally broke out to the upside, there were significant profits available for those holding long positions. On this chart, you can see prices breaking down through the lower edge of a bear channel. If a trader had placed pending stop orders on either side of the channel, the breakout should have triggered a sell stop, resulting in a profitable short position. Of course, trading a range like this requires a little more work than is needed for one with horizontal support and resistance. Because the lines of support and resistance on this pattern are sloping, the levels used for the pending orders will need to be constantly updated to ensure that they reflect the current state of the market. Although we've only shown you a few examples of breakout trades, it should be clear that they have the potential to offer substantial rewards for traders that are able to set their pending orders at the correct levels and then have the patience to wait for the breakout.